All right, good afternoon, everyone, and welcome to today's session. Really excited for this one. We're still covering the essentials, going over the wheel strategy. So excited to have everyone here, and I hope everyone's having a good week thus far. So today I am joined with Tony. We're going to go through this really exciting strategy. Notice there's a lot of questions around this. It's growing in popularity, has a lot of names. Has been around for a while, but the name the wheel strategy is certainly something that's come up quite frequently more often. So for today, this is in that course. So I want to just remind everybody, if this is the first time you're joining this is definitely a building upon the courses that we've been creating thus far. So we're still on the essentials of options education. It's definitely a prerequisite for this one to understand options pricing and understanding calls and puts. We're going to go over specific strategies and application, which I'm really excited to share with you. So that's the first step within this course as far as actually implementing what we've taught you. But I will give you some reviews. That way you can stay up to speed. But if anything feels rather foreign or something like that, just know those other videos are available, and please feel free to watch those on YouTube. They are available. So of course, naturally, before we dive in, have to give you some disclosures. So types of securities, forms, and research tools used in this video are for demonstration purposes only, and should not be considered a recommendation by OptionsPlay or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. All examples are for illustration purposes only and do not include any commissions or fees. So let's talk about what we're going to cover today. Of course, naturally, it's the topic that we're looking for, which is what is the wheel strategy? So I'll give you a brief overview of exactly what that is. That way we understand it. We'll add some clarification with the review of covered puts and covered calls. That way, if you're not familiar with it, you can at least follow along, and we'll go through some really detailed examples with practical application. I will use ABC just to keep it evergreen. And then I'll hand it over to Tony, where we'll talk about optimal covered puts and optimal calls, how to utilize tools and resources to choose strikes and expirations, which is always the question that we get in between when talking about a strategy is how do I choose that? So just know that we're going to cover that once we get to the end of it. And we'll also talk about opportunity reports. So again, those tools and resources that are available to you within the OptionsPlay platform, and of course, trading tips. But the main takeaway that I want you to get from today's session, and this is the question really that we're going to answer with the wheel strategy, is how can I maximize yield and participate in capital appreciation utilizing options? That's really the intent of it, which we'll go through in much more detail in a moment. All right. So what is the wheel strategy? So I spent a lot of time yesterday trying to put together this illustration just to really give it a good visual of what the wheel strategy is. So it is designed to create continuous income. So that's what this is. Whenever you sell an option, you collect premiums in exchange for an obligation. So the put obligates you to buy the security when it's below your strike. The call obligates you to sell the stock when it's above your strike. And when you're selling options individually, your goal is for the contracts to expire worthless and not be assigned. But when you're trading with the wheel strategy, you welcome assignment. In fact, it's ultimately your intent. You're okay with buying and selling the underlying security. So you actually use these obligations as entry and exit points. So the point of it is you sell a put and you collect premiums. If it expires, you just keep doing it. So it goes in this wheel. Once you're assigned, you then have to buy that stock. But once you buy that stock, you then sell a call against that stock and use that stock as collateral and just keep going through that cycle. In that process, you're able to purchase the stock at a discount because you're collecting premium from selling the put. And you also participate in the capital appreciation of the underlying security. So I know I threw a lot there, and this is what we're going to explain throughout. So don't expect to all of a sudden follow along exactly what I just said right there. The intent was to show you the purposes of the wheel strategy, and we're going to add clarification as we go along. But essentially, it's if you buy and sell stocks with limit orders, then this is a strategy that's for you. It's a way to maximize your income. So wouldn't you rather want to purchase the security at a lower price and sell at a higher? That's really your intent when you're trading. So the purpose of the wheel strategy is to utilize options and that obligation that selling options provides by defining those entry and exit points. So you're still buying and selling stock, but you're utilizing options in order to do that. And of course, we're going to add some clarification to that along the way. So I do want to review a covered call real quick. So the next 2 slides is going to be a review before we get into the meat of it. But when you're writing a short call, you sell the right to buy a certain amount of shares at a specified price within a certain time frame. So remember, the long call holder, the person who owns that call, they want the underlying security to go up as much as possible. You're on the other end if you are selling that call. You collect the premium. You don't necessarily want it to go up as much as possible. You only want it to go up to the strike that you specify. So with a covered call, you actually shift the profit and loss diagram to a positive end. So what I mean is, if this was a naked call, so I didn't own an underlying security, it actually would be on the other end, because that's a neutral to bearish. But since you own a stock in this situation, you have it as collateral for your covered call. It actually turns into a bullish to neutral, or excuse me, neutral to bullish position. And that's the importance here. So you're just think of this and keep this in your mind the whole time as we go through this. If you're used to buying securities, the max you can lose when you're purchasing a stock is your investment amount. And it's really a similar risk profile with this strategy here. So the max I can lose is what I spend with the stocks, and the same is relatively true for the wheel strategy. And we talk about reducing that risk and maximizing gain throughout. So for a covered call, you have to own at least 100 shares of an optional stock or ETF. So this line represents the stock. This is how much I can potentially gain. It's an unlimited. This line would go forever. So as the stock goes up, my value goes up. As the stock goes down, it can only go to 0. Again, that's the maximum amount that I can lose, is what I invested in the security. So that's 100 shares of the stock. You sell a call option and you utilize that stock as collateral, because remember, when you have a short call, you're obligated to sell at that specified price, which is the strike price. And if you don't own the underlying shares, you could have unlimited risk. But by owning the underlying shares, you've already bought them. So you're just specifying a price at which you would sell the security at, and your underlying security is the collateral in that situation. And when you do that, you collect a premium. And when you receive that premium, it reduces your cost basis. So if you are giving up upward potential. So if you bought ABC at $100, you sell a call with the obligation to sell at 110, maybe you receive 2. Instead of your cost basis being 100, now it's 98. You've reduced it by the amount that you premium received, but in exchange for an obligation. And you also give up your upward potential. So that's the risk reward with owning the underlying security and then selling a covered call against it. If you sell a covered call against it, you are capping your upward potential, but you're also reducing your cost basis at the same time. And that's where it's important to choose optimal strike prices and optimal expiration date, which we will absolutely go through in a moment. But what I want you to take away from that is understanding just the risk and reward there. And I do see a lot of questions coming in. We'll make sure we've got adequate time at the end to go through those in case I don't answer them. All right, so going through a cash covered put, similar risk profile, actually exactly the same profit and loss diagram. So just remember, the long call contains the right to buy. So therefore, the person who sold that call has the obligation to sell. The put is the inverse. If you remember that profit and loss diagram that I've shown you at the beginning of the other webinars within the series. So the long put holder has the right to sell at the strike. You as the short put holder have the obligation to buy at that price. So that's where the obligation comes in. Same type of scenario if ABC is trading on the market at 100 and the put has a strike of 110, you hold the, as owning the put, so not the short put, you hold the right to sell at that higher price at 110. Therefore, the obligation on the short end would be kicked in. So there is substantial loss potential with this as well. Same thing. Since it contains the obligation to buy, if that obligation is invoked or you're assigned, then that's the max amount that you can lose. So that's what I want you to take away from that. If you're not following along, is simply the risk profile of the covered call and the cash covered put is very similar to just owning the security itself. So you have to have cash readily available to buy the stock or ETF because you have an obligation to buy. You have to have the cash available if it's going to be considered covered. And this is a strategy that you can do normally even in a retirement account. It doesn't require margin or anything like that. You sell a put utilizing that cash as collateral and receive a premium in return. And then it creates that obligation to buy the stock or the ETF at a specific price. So what's in common with the cash covered put and the covered call is an obligation to buy and sell. The put contains the obligation to buy, the call contains the obligation to sell. And if you think about, if you've utilized a limit order before, you really do the same thing. If you were to put in a limit order and buy ABC at $100, you've got to have that cash available or your broker is not going to allow you to place that trade. And that's the same collateral with the cash covered put. This it'll execute if it hits your price, whereas the put is waiting on more directional movement, but you collect premium while you're waiting for it to execute. And then the inverse is true with the covered call. If you were to put a sell order in for a stock, your securities are collateral while your securities are sitting there. Yes, you do collect dividends and you could still participate in capital appreciation as the stock goes up, but the covered call allows you to maximize that yield while you're waiting for it to hit your exit price. And so that's what we're going to go through, is really utilizing these strategies, replacing buy limit and buy sell orders. So if you're the person who buys and sells securities, this is a way to buy at a lower price, participate in that capital appreciation like you normally would, collect additional income along the way, and choose your price targets just like you would with limit orders. All right. And then I did have some polls I wanted to throw out there. So let me go ahead and do that now just for a quick little knowledge check. So number one, I do want to know, just to ensure how much we have to go through, is if you've attended any of the other sessions. So I'm going to go ahead and put that out there if you guys want to participate in that. All right. So most of you had, that's nice. All right, so I'd say that's a pretty healthy mix. Just want to make sure I give you the adequate support before we move on, because that's going to be really, really important. Do want to do a quick knowledge check as well before we move on. So I'm sorry I'm putting these all up front, but it's important. So this one is a short equity call holder is, and I've got the answer on the screen, so we'll kind of move it over. So I launched another one if you guys want to participate in that. And while that's coming in, I do see a couple questions about naked puts or covered puts. It really depends on the type of account that you have. A naked put requires margin, a covered put requires cash. So it depends on if you have a taxable account or not, and things of that nature. Either one will essentially work. If your goal is to buy the stock, you have to have the cash anyways. But if you want to maximize leverage, you can, of course, do a naked option. That's fine. But the idea of this and the true wheel strategy is a cash covered put. All right. So I'm going to go ahead and end that poll. So remember, if you are a short holder of any options contract, you have obligations. You are not able to submit exercise instructions whatsoever. The best way that I like to think of it is you're driving in a car. If you are a short option holder, you are the passenger. You can look around you, you can see things around you and get a good idea what the driver is doing. But at the end of the day, the driver is the one making the decision to go left or right. So that means they are able to submit exercise instructions. So that's number one. The call is the obligation to sell. So the answer to this is obligated to sell the stock at the strike when assigned, which most of you got. So that's good. But that's important to know when you sell a call or you're a short equity call holder. At that point, you are obligated to sell the stock. I'll share those. All right. So let's look through actual application. So, and we'll look through this scenario as well through the eyes of someone who trades just stocks and someone who trades stocks and options. And that'll help build some clarity because I'll go through the exercise and assignment process. What would happen if the stock moves in various directions? I think that's going to be super important here. So I've got a chart up of ABC. So this is a real security. Maybe one of you will figure out what it is, but to keep it evergreen, we kept it as ABC. So this is a screenshot of OptionsPlay's platform. It's got some really great technical indicators on here. So I can see that it blew through its support, or excuse me, its resistance. Its old resistance became new support. There's a bullish trend here. RSI is looking positive. So everything here is giving me an indication that this is a bullish security, including the 1 month and 6 month trend. So looking at this scenario from purely a stockholder, I would probably put my buy limit at 50. So right here, current price, and a sell perhaps around $58, which would line up back here. From a pure stockholder or stock trader investment perspective, I would, if I was buying 100 shares, risk $5,000 to make 800 if that's where I feel those securities going to go. So if I feel like ABC is going to go to $58 and I'm going to buy at 50 and I'm going to buy 100 shares, I'm going to spend 5,000 of my dollars because it's a security, and the worst case scenario is that it can go to zero. That's my maximum risk. And then my maximum reward, just on the eyes that I'm seeing in my target exit price, which is super important. It's something we talk about a lot, is that exit strategy. I'm risking 5,000 to make a reward of 800. So let's see what that would look like if I was purely trading the security or if I was going to implement the wheel strategy. So we've got day one. Both the stock only holder and the stock and options trader have $5,000. The stock trader puts in a buy limit order of 100 ABC at a $50 limit. That immediately is going to execute because it was at 50. So they're going to be debited $5,000. The stock and options trader is going to sell to open 1 ABC 50 May 6 put at 315. So approximately about 30 days out, they're selling an at the money put in this situation because the strike price is equivalent to the market price. So not one isn't favorable than the other, it's purely equivalent. So that means that this entire premium is made up of extrinsic value. If you don't understand what that means, options pricing is something to refer to, and we spent a really long time going over exactly what that means. So the stock break even is 50. So that's the max amount that the stock investor can lose per share, because that's the max amount that they spent. And that I'm going to repeat that over and over again. In exchange for that $5,000 that was debited, stockholder now has 100 shares of ABC worth $5,000. The stock and options trader holds a short put with the obligation to buy 100 ABC at $50 up until May 6th. In exchange for that obligation, they received $315, and they have to put up $5,000 as collateral. So that's sitting there just in case that execution comes by, and that's in the case of a cash covered put. They're credited that $315, which reduces their cost basis by exactly that amount. So instead of being able, or their maximum loss being $50 per share, in this case, it's $46.85, because they would be obligated to buy at 50. And remember, that obligation will come in if the stock goes down. So if the stock goes down, then they would purchase at 50 and $46.85 is their break even. Whereas the stockholder, if ABC were to go to $46.85, they would be losing money. The stock and options traders actually collected premium in this scenario. So let's just see how this plays out, and we'll add some clarification. So assuming here until expiration, ABC goes up $1, it's up 2%. So the stockholder, pretty simple, the stock goes up the equivalent amount, so up 2%, the stockholder made $100. The stock and options holder, they're not obligated at this point to sell because that put isn't worth anything. And the reason that put's not worth anything is because it contains the right to sell, and selling at $51 is more favorable than 50. Therefore, they are not obligated to purchase. So if it contains the right to sell, they're the seller, they're obligated to buy from the seller. That's where that's coming from. So in this scenario, they've kept that $315, turned their $5,000 to $5,315 and made 6%. So that's what's happened here. And remember, I'm going to look at these scenarios purely from an education perspective all the way till expiration. There are lots of variations where you can roll up and down and scenarios that you could really maximize on this. But as far as purely as understanding, I think that's important to know, is just capitalizing on that premium. All right, so now that, and this is now day 33, because remember that's on a Friday. The option expires on the Friday. That following Monday, we want to remind ourselves and make sure we go back in and sell that option again. So that's what the stock and options trader is doing at this point. Now they've recreated that obligation, sold another at the money put approximately 30 days out, and this time received $3 in exchange for that obligation. So now they have an obligation to buy 100 ABC at 51. So this is $1 higher than the previous obligation. So therefore, this $3, that's where this difference is coming from. So they received $300 premium altogether, and now $5,100 worth of their cash is collateral. That's the important there. So again, by just bring back that picture of the wheel strategy there, this is the point where the option expired. Therefore, you're not moving towards the other side of the wheel. You're just staying up here and you're going to continuously sell puts until you're assigned. And as you're continuously selling those puts, you're continuously reducing your cost basis because you're collecting premium along the way. And do you know the risk with the short puts? I think I saw a question come in there, is essentially upward momentum, if you will. When you're buying the security, you can really capitalize on that. And I'll talk about that a little more. We've got an example in there. All right, so going to day 61, which we're going to call June 3rd, ABC went down. So we were wrong about our price targets, but that's okay. Both the stock and the stock options holder want to own the security. So keep that in mind. I'm bullish in ABC. This is a stock I want to own. The stockholder is buying it. The stock and options holder is selling puts in order to kick in the obligation to buy it. At this point, that obligation did come into play because they had a option that obligated them to buy at 51. So since it contained the right to sell at 51, so the long holder had the right to sell, short holder obligation to buy. 51 is more favorable to sell at than 50. That obligation kicked in. They spent $5,100 total. So 51 times 100 shares, that's subtracted, but they keep that premium all together. So in this scenario, the stockholder and all of these percentages here and throughout are based on day one. So that's the percentage changes that I'm looking at. It's not from day to day, but from day one. So from the $5,000 investment, we're flat at this point. From the stock and options perspective, the $5,000 investment, we're up 10% now. So the stock hasn't moved, but because of sold puts to collect premiums in order to buy that security, I've made $515. So that's the 315 I collected, the other 300 that I collected. Remember, I bought at $51 per share, not 50. So the difference of all that gives us the 515 that we've made. So now that we own the security, we've got to go to the other side of the wheel strategy, and that's to create a sell order. So now that we own the security, we're going to create an obligation. So the stockholder is going to enter a sell limit order of 100 ABC at a $58 limit. Now this time, it's going to be an open order. So if you've had placed a limit order before, you can specify it even for an expiration period, but it will sit there until the security hits your price. And in exchange for it sitting there, you can't do anything else with the shares, you can't sell a covered call, can't do anything with it. That becomes collateral for your open order. So that's what the stockholder has done is I want to walk away. I want to sell my shares at 58. When that happens, it's going to execute. I'm happy with my gain. In exchange, those 100 shares are tied to that order. The stock and options trader does a similar thing. So now they sell the call. There's a specified period here. So we're going out just another approximate 30 days. And the short call here is at 55. So this means that they would have the obligation to sell the shares at $55 per share. So this one's a little more out of the money. You notice with the short puts, they were at the money, and that's because we wanted to buy the security. So we were okay if it ended up going down and we purchased the security, and that was absolutely fine. With the call, we're looking for upward momentum, and that's part of the capital appreciation that we want to participate in. If you were to sell something at the money, then you're going to give up that upward potential, which really helps maximize your yield, something Tony will talk about a little more deeper into the conversation. So when I sell that call, I have to give my 100 shares of ABC as collateral. So this, and because I'm saying I am obligated to sell at 55 at the person I sold that call's to discretion. In exchange for that obligation, I'm receiving $2 per share. And that again, reduces the cost basis. So now I've added $200, have the obligation, stock as collateral, reduced cost basis. And now you can see the stock's break even has been consistent, but by implementing the wheel strategy, we've already reduced the the cost basis of the security to 42.85. Important note, when I say cost basis, that is purely for education purposes, not tax cost basis. Acts completely differently. If we want to go through that, send us a question and I will reply with an email. All right. So moving on, let's see what happens now when we hit July 1st. So ABC actually went up. So the stockholder made 4%. The security went up $200 in value. The option holder, this one expired because we have the right to buy at 55. Buying at 52 is much more advantageous. So therefore, the short call holder did not have to fulfill their obligation of selling the shares because it wouldn't make sense for the long call holder to exercise. And they kept their entire premium of $2. So the altogether, the stock and options holder in this scenario has made 14% now. So up 915 altogether, inclusive of the $200 made on the security and the 715 here. So now that it's expired, the option, or we want to go ahead and sell another option. So now we're in that wheel. So remember, anytime you're dealing with the short calls on either side of the wheel, if it expires, you just keep in that cycle until you're assigned. So now we're doing that here. So we're going to sell to open another 55 call at $2, collecting that premium, get a credit of $2, and reduce our cost basis once more. So now we've received another 200, have the obligation to sell 100 shares of ABC at 55, so still kept that same price, and our stock valued at 5,200 is the collateral. So now, let's say there's a magical tweet by someone or the great earnings, something like that, and the stock suddenly skyrocketed 10%, and now it's at $60. So what happens in this scenario? Well, there was a limit order for the stockholder, so it's just going to automatically sell because he sat and forgot it, and went out wherever. That's gone. They're going to receive $5,800 worth of cash. The contract is going to be assigned so that an obligation to sell is going to be invoked, and they're going to have to sell their shares at $55 per share. So we bought at 51, we sold at 55, but we collect premiums all along the way. So in this scenario, the stockholder turned their $5,000 to $5,800, made 800, up 16%. Stock and options trader did about the same thing, as in strategy wise, but they spent $5,000, turned it into $6,415, and made 28%. So that's where the difference is there. So utilizing the wheel, and I'll go back to that slide. You can see how just constantly collecting the premiums allows you to purchase the stock at a discount and create that continuous income. So you're constantly selling short-term calls or short-term puts, and you're reducing really the max risk. Because again, look at this through buying a stock. When you're buying a stock or an ETF, the max you can lose is the max amount that you can spend. So by selling premium and utilizing the stock as collateral, you're just reducing that risk and really maximizing and gain in a way. You do give up upward potential when you're selling a call, but theoretically, is it going to go to a skyrocketed price? This is a good way to maximize that income throughout the way. All right. So I'm going to hand it over to Tony, where we're going to talk about choosing optimal covered calls and utilizing the platform.
Thank you so much, Jess, and thank you so much for that deep dive into the wheel strategy. We've talked a lot about these two strategies separately here at OptionsPlay. I think this is the first time we've put it all together into a single strategy, because it really is a single strategy that you could utilize for all of the equity investments that you hold in your equity portfolio. And it really allows you to start maximizing the ability to use options to generate income for your portfolio. So let me take this to and start building on top of what Jess has shown you here today, using some examples with ABC stock and talking about the application of these strategies in your actual portfolio. So when we talk about cover calls, we have to look at what expiration date and strike price do we choose for this specific strategy. So I have an exercise here on the screen. I have Cleveland Cliffs, a stock that many of you may have looked at here over the past few months. This is one of the stocks that was in our daily play portfolio not too long ago. It's had a very strong run here since we've added it to the portfolio. And I want to use this as a thought experiment to look at how do you choose expiration date and strike prices for a stock like Cleveland Cliffs. Now, the stock is currently trading just a little over $30 here, and you have a variety of choices when it comes to expiration dates and strike prices. So I want to take a look at having a few choices and showing you on the screen as to how should you go about selecting the appropriate expiration date and strike price for a stock like Cleveland Cliffs. So let's say the stock is currently trading around a little over $30. I have three choices here on my screen. Let's say I have the choice of the 34s, the 36, and I'm also going to choose the 38. So I'm going to mark these off on the chart itself as to how far does the stock need to rally over the next, let's say 45 days before the stock is called away. Now, the 38s will collect 63 cents in income, the 36 will collect 94 cents in income, and the 34s will collect $1.41 in income. This is pricing based on the market earlier today. And I just want to get a sense for everyone here on the, here on the session. Type the answer into the chat window as to which strike price you would choose, the 34, the 36, or the 38 strike price when you're thinking about selling cover calls on a stock like Cleveland Cliffs. Which strike price would you choose? Okay, I see a lot of 38s, I see a lot of 34s, and that is generally speaking, when I ask this question, where I see most of the answers, either at 38 or at 34. So let's walk through how do we choose which one of these strike prices should you pick when you're selling a covered call. So first of all, I'll just start off by talking through our backtesting. We've backtested just about every single strike price and expiration combination for just about every single stock going back from 2007 to today. And when we test different strike prices and expiration dates, it's very clear to us that there's a single expiration date and strike price that yields the best outcomes in the long run when it comes to selling covered calls. And when I refer to the best outcomes, what I'm referring to is, one, capturing income on the strategy, because that's why we're here. We want to capture income. But number two, there's another important factor to remember when you're selling a covered call, which is capital appreciation of the stock that you own. Because you own the stock because you believe it's going to rally in price in the future, and you're trying to capture that rally by profiting from that. So that's really a very important component of selling a covered call, because you don't want to just collect income and then give up capital appreciation of the stock, because that defeats the purpose of why you own the stock. So when we test this theory, when we test out all the different possible expiration and strike price combinations, for us, it's very clear that the strike prices that are further away, that actually generate less premium and less return, is actually the one that gives you the best outcome in the long run. Because as you can see here, the 34s collects $1.41. The 38s collect 63 cents. That's less than half the amount of income that you would receive if you sold the 38s. But this roughly 80 cents in income that you are giving up, if you will, when you select a $38 strike price, translates on the back end to $4 in capital appreciation when the stock rallies. So you don't know when the stock is going to rally in any given month, but when it does, what you want to do is make sure that you capture not just an extra 80 cents in income, but that you capture the extra $4 in capital appreciation, because that $4 is going to provide far larger gains into your overall portfolio than the extra 80 cents that you're going to get on that $34 strike. I tend to find that a lot of investors, when they're selling cover calls, they tend to gravitate towards these big numbers. They want to see 38% annualized return versus 17% annualized return. Doesn't 38 sound so much better than 17? Don't be deceived by that, because what you're doing is you're giving up so much in upside capital appreciation that you are basically trading that off. You're trading off $4 on the back end for an extra 80 cents. That is a recipe that's not going to work out for you in the long run. Even though this has a 15% chance of being of the stock rallying to that strike price, this has a 30% probability of that happening. So in the small chances that the stock rallies significantly, you give up so much more upside when you choose that strike price with the higher premium. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you, as to why when you're selecting cover calls, you want to select actually the ones with the lower premium, the lower income, because that's going to translate to significantly higher capital appreciation of the core asset that you're holding, which is the reason that you're holding onto the stock, is because you think that stock is going to appreciate in value. You better be able to capture it and not give that up when you're using a strategy like a cover call. So that 15 delta is the optimal strike price when it comes to selling cover calls. I'm going to show you how to find the 45-day 15 delta using OptionsPlay. But before we do that, I just want to do the same thought experiment for a short put. I'm going to use American Airlines here. Airline stocks have really struggled here. That many times you might have opportunities to have purchased some of these stocks as they decline here. Maybe this is another opportunity here in American Airlines where you think that, okay, now oil prices starting to collapse a little bit back down. A newer opportunity as travel gets back to reopening. Now let's take a look at American Airlines trading at 16.5 bucks. Let's take a look at a few different strike prices that you could sell puts for. Let's say the 16, the 15, and the 14. And they all reflect how far does the stock need to decline into the future before the trade is, before you are effectively assigned and own 100 shares. And now you own 100 shares of American Airlines at a specific price. So if you sold the 16 strike price, you'll collect 85 cents. You select the 15 strike price, you'll collect 52 cents. The 14 strike price, you'll collect 32 cents. And here are the corresponding raw returns and annualized return. Raw return tells you how much you'll collect in the next 30 days between now and expiration. And the annualized return is basically taking that 30-day return and annualizing it over a full year. So which one of these would you pick, the 16, the 15, or the 14? Please type your question into the chat window here. Okay, so here I see a lot of 14s. I see a few 16s and a few 15s, but predominantly in the answer seems to be the 14s. And perhaps this could be because you've learned what we just talked about here in the previous example of choosing strike prices that are further away from the current stock price. But this is where our research shows the exact opposite. You want to select strike prices close to the current price of the underlying stock itself. And this is for two primary reasons. When you're selling a short put, you remember that the goal is to own the stock, right? You're selling a put because you want to own the stock. You want to participate in future capital appreciation. But you're only going to capture future capital appreciation if you end up owning the stock. So if you choose strike prices that are very far away from the current price of the stock, there's a low probability that the stock is going to decline that much before it continues to appreciate in capital. So the further the strike price away from the current price, the less probability that you're going to end up owning the stock, which is why you want to choose strike prices close to the current price. That increases your probability of owning the stock. And number two, it also increases the premium that you collect or the discount factor that you receive on purchasing the stock itself. So when you're selling a cash secured puts, you want to select strike prices close to the current price of the stock. And then when you're selling cover calls, you want to select strike price further away from the current price of the stock. Does that make sense? Please type 3 into the chat window if that makes sense to you. Perfect. Okay, so like I said, what I want to do is teach you the practical aspect of how do you select expiration dates and strike prices, but we also want to show you how you can implement this using the OptionsPlay tool. So this is really where you can log into your OptionsPlay platform, and there's a few different ways that you can analyze and access these types of strategies using the OptionsPlay platform. First, you can use either the cover call and short put reports, or you can use the income tab on the OptionsPlay platform. We're going to look at both here and show you how you can utilize the platform to find these opportunities. So let's first jump over to the OptionsPlay platform. For any symbol that you are looking at, whether it's something that's in your watch list or a symbol that you're looking at from our trade ideas, or a symbol that you've typed in, you have a trading tab, and then you have an income tab here on the right hand side of your screen. So today what we're going to do is we're going to look at the income tab, and this provides the starting points for selling cover calls and cash secured puts. Now, what I always encourage investors before you use this tab is to click on the income settings button here on the lower right hand corner. And when you click on income settings, it'll allow you to choose how you select your strike prices for cash secured puts and cover calls. So when you look at calls, short, medium, and long term in terms of how far out in expiration, we tend to find that the shorter dated options will be best for these types of strategies. And then for a risk tolerance, you can choose conservative, optimal, or aggressive. So when it comes to cover calls, we always shoot for either conservative or optimal strike prices that are further away from the current price. And then when we're looking at puts, we get aggressive strike prices that are close to the current price of the stock. That's the default settings we use for these types of strategies. So for any symbol that you type in, every time you pull up the income tab, OptionsPlay will seek the exact expiration date and strike price based on your income settings. So if, let's say, we're looking at Goldman Sachs currently trading at $314, this is going to select the April 29th $350 call option, because these are call options that are relatively far away. And what you can do is you can utilize this tool to help you get a sense for the annualized returns of these types of strategies. And what you generally want to do is compare the annualized return to the dividend yield. That's going to give you a gauge as to how much income you're actually collecting on these strategies. It's important to use the dividend yield to gauge how much premium you're actually collecting when you're looking to sell a cover call or a cash secured put. So Goldman Sachs earns currently about 2.25% on the dividend yield. You're going to collect about double that here on the cover call, and you're going to collect significantly more than that on the short put. So this is one where you're going to collect a lot more premium from selling put options on Goldman than you are going to sell on covered calls. And it's important just to understand how much premium you are collecting. And you can do this for any stock. In the universe of stocks that you own, I usually suggest that investors create a watch list using the stocks that you currently own in your portfolio, and that would allow you to quickly go through that watch list and see which strategies give you the best cover call or short put opportunities on the stocks or holdings that you either are looking to acquire through a short put, or the stocks that you currently own in your portfolio in your portfolio for a covered call. The other place that you can use using OptionsPlay to find these strategies is in the Education and Resources Hub. And this takes you to the OptionsPlay Hub. And within the OptionsPlay Hub, you have both a cover call and a short put report. This is designed to also shortcut the amount of time it takes for you to find the exact expiration date and strike price for the symbols in your portfolio. So when you click on the report, it will bring up the cover call and short put report. I generally tend to find for cover calls, you simply just search for the holdings that you have in your portfolio. So let's say you own Snapchat. You simply type in the symbol. I thought I saw Snapchat here earlier before. Maybe it's not on the list here for today. But you can type in the symbol of the stock that you own, and it will present to you both the expiration date and the strike price. So let's say we look at LI, an electric vehicle stock, a very popular stock these days, selling the May $34 strike price will collect roughly 50 cents in premium, which is 1.92% of the stock's value that you're collecting on that cover call. And you can even click on the link, and that will bring up the strategy so that you can utilize this strategy for within OptionsPlay and view this strategy within OptionsPlay and see the exact yield analysis of the strategy along with all of the underlying technical information for you to decide whether or not this is a stock that you might want to sell a cover call on or not. So this automatically selects the expiration date, the strike price, and gives you the information that you need to decide whether this is the stock that you might want to sell a cover call or cash secured put on. And this report is designed to really, again, make your life a lot easier when it comes to finding the expiration date and strike price, because it already does that work that I showed you here before when we were looking at Cleveland Cliffs, finding that May $38 call option. That's what this report does automatically for you for the names within the report, so that you don't have to search through an options chain, find the right expiration date, the right strike price. This report does all of that for you, gives you the yield analysis, as well as things like the earnings flag. So you can know whether there's an earnings coming up between now and the expiration date. We have the implied volatility rank so that you can understand whether this is the right, best environment to sell cover calls for this particular stock or not. Higher implied volatility rank will give you a better environment to sell cover calls, and also gives you the distance to the underlying stock price, strike price, that the stock would need to rally by that amount before the stock is called away. And as you can see, for many of these names, the stock has to rally 30, 40% before the stock is called away. You know, those gives you a lot of room for capital appreciation. Remember, the stock has to rally by that percentage in just the next month, month and a half. You know, generally speaking, when that happens, that's a really good outcome for the underlying stock that you've owned. You know, for a stock that you own to rally 30, 40% in a single month, month and a half, that's going to be a great outcome for you to be able to take profits on that by selling the call against that call, that stock position. And then if the stock does get called away, that is a profit for you that you can then use in the wheel strategy by selling puts for the next stock that you want to purchase. And that's really what brings us to the short put report, which works the exact same way as the cover call report and gives you exactly the same information. So for stocks that you are looking to acquire, which strike price do you want to use? So for example, if you're looking at Pinterest, which is currently trading just a little over $23, this is telling you to sell the May 6th $23 put option, which collects 7.73% of the stock's value. So if you use a short put to acquire Pinterest using the short put rather than the stock itself, you're going to get a 7.73% discount on the stock purchase. And if the stock never gets assigned to you, you're going to collect 7.73% yield on your cash over the next 30 days. That's a fair amount of yield that you're going to collect by using a strategy like this and deploying your capital in a manner similar to this to purchase stocks that you want to purchase. Now, remember, a few things that you want to remember when it comes to these types of strategies is that you want to focus on stocks that you are familiar with. So when you're thinking about selling a cash secured put, you should never sell a cash secured put on a stock that's in the report that you've never heard of. Only sell cash secured puts on stocks that you would be investing in if they were not on the short put report. That should always be the fundamental basis for why you sell a cash secured put, because the risk with the cash secured put is that you're going to own that stock. And there was a lot of questions already when Jessica was talking earlier as to what do you do when the stock drops, right? The answer is, what do you do with any stock that you own and the stock drops? You have to make a decision. Do I hold on to this stock or do I sell it and allocate my capital somewhere else? You know, that's a decision only you can make. And that's a decision that you can only be be able to make if you understand the investment itself. If you don't understand the stock that you're investing in, it's difficult to decide when do you cut your losses or when do you stay in because you believe your thesis is still correct. So the fundamental basis for the wheel strategy is to focus on stocks that you're familiar with, because that's going to help you determine whether it's a stock that you'll continue to hold on to for a period of time, or it's time to say, hey, this is not going the way that I expected to. The company's not performing on par with its peers. I think it's time for me to cut my losses and move on. The second thing that you want to take a look at here is a high yielding income portfolio. This is really where the report makes it really easy to focus on higher yielding opportunities. You can use the report and sort it based on the raw return. And that's exactly what the default sorting for these reports are. It tells you which names in this report yields the highest raw return. So what you can do is you can effectively go down this list and start looking for stocks that you like and stocks that you understand. Maybe you know what Etsy does because you've purchased a lot of goods on Etsy. So you're familiar with the platform, you're familiar with the stock, you're familiar with their revenue model, and you're comfortable being a buyer of Etsy. So that's how I would use this report and say, okay, if I use a cash secured put to purchase Etsy, then I can purchase the stock at about almost an 8% discount versus buying the stock. But then perhaps I'm not familiar with Pinterest or Roblox. I'm not familiar with Lee, and I can go down and I can say, okay, CarMax, I know that company. I'm familiar with that, their revenue model. I'm comfortable with investing in this particular company, and I would go across the board and see how much yield I can collect on a purchase of CarMax using cash secured puts. That's how I would utilize this strategy to find high yielding opportunities and build a portfolio using the wheel strategy. And if you have a small account, I get a lot of questions from investors saying, I have a really small account. How do I work with this type of strategy? Because I can't afford to sell a cash secured put on SPY or Amazon or Netflix. Those are hundreds of thousands of dollars or tens of thousands of dollars. Well, we created this report so that you can sort it based on the stock price. So for example, if we're looking at the short put report, you can look at this and you can see American Airlines. I picked this because it's a low price stock. It's a $16 stock. So to sell one contract, you only need $1,600. So even some of the smaller portfolios can utilize this strategy using our report by sorting this report based on the stock price. And as you can see, that's how I found American Airlines. It's one of the better yielding opportunities in this market that generates still almost a 5.5% yield in just 30 days, but allows me to potentially capture a stock that perhaps you think is at a buying opportunity here, or Jets ETF, the airline ETF. Maybe you think you're going to get an opportunity there. Pinterest as well, 7.75%. Peloton, maybe you think Peloton's taken such a large hit now, it's time to be a buyer of Peloton. However you go about investing your cash in investments, this report finds opportunities that give you a much better entry point on your positions using these types of strategies. And then you can use the exact same cover call report for the same thing. And lastly, sort this based on the earnings flag. You generally don't want to sell any of these types of strategies if you are initiating one where the stock is reporting earnings in the next few days. If the stock, if you have a 45-day option and the stock reports earnings in 35 days, I tend to find that you're okay selling cover calls or cash secured puts, because you can always make a decision as you get closer to the earnings date as to whether you want to remain in that option or not. But if you're going to sell an option where the stock reports earnings in the next week, that's generally where I tend to avoid this type of strategy. So those are some of the tips that I have for utilizing this report and how to find opportunities that suit your particular portfolio, regardless of the size of your portfolio and how the type of investments that you typically make in your portfolio. And with that covers what I wanted to share with you and what Jessica, and I want to thank Jessica for taking the time here today and showing you that in-depth analysis of the wheel strategy. Again, something that we have covered separately as cover calls or cash secured puts, but never put together quite as elegantly as Jessica put together with the graphics that she did. So I want to say a huge thank you to our members for supporting us and allowing us to continue to invest and build in education like this for you as a member, so that you can understand the strategy and understand how to use the platform and the technology to help you implement these strategies. So if you are brand new to OptionsPlay, you can sign up for a free 30-day trial. It's going to give you access to live events like this to learn more about options trading, and access to all of the reports and access to our platform for free for 30 days at optionsplay.com. And we strive to build the most intuitive options analytics and education. As part of your free 30-day trial, you're going to get access to daily options ideas. So for those of you that are currently members, you're getting entry and exit signals from Rick and his research team of the best ideas that our team have put together, not only of the underlying stock, but the option strategy to trade on the back of that. You get weekly education with Jessica and I on these options education sessions, and bi-weekly market outlook sessions, one with Rick, one with Prakash. And lastly, access fully to all of the tools that we have here: the hourly cover call and short put reports, credit spread reports, straddles and strangle reports. These are all reports that Jess and I will be doing more education on going forward. There were a lot of questions regarding how to access some of these courses that Jessica and I have put together, or rather Jessica has put together, and we will be putting together a playlist, and Jessica has put together a fantastic syllabus for beginner, intermediate, and advanced courses for seasoned traders, whether you're trying to get getting started or trying to achieve mastery in some of these strategies. We're going to be putting this all together for you in a course style format. So with that, what I'm going to do at this point is open this up for Q&A. I'll welcome Jessica back into the room here at this point, and we'll take some questions. There's a lot of questions in the Q&A window. I don't know if we're going to be able to get to all of them, but we will certainly do our best to try to get through as many as possible. And thank you so much for those of you that wished us well, and thank you so much for that. I'll start off by answering some questions, that are at the top of the Q&A window that I saw when Jessica was on before. I would say one of the most common questions that I get from investors regarding this type of strategy is, what do you do, after you sell the cash secured put or after you sell the cover call, as to once the stock drops significantly? If you an earnings event, something happens, you sold the cash secured put, you sold the cover call, and the stock drops heavily, what do you do? I always say to traders that the cover call and cash secured put never in any way mitigates the possibility of the stock dropping, right? You always have that possibility. But if you implement the wheel strategy and you use high yielding opportunities with the wheel strategy, number one, what you're going to get is some downside protection. The premium that you collect on the short put and the premiums that you collect on the cover calls month to month, that's going to provide some downside buffer on that move to the downside. So it doesn't prevent the move to the downside, but it makes it hurt significantly less. The second thing I want to point out is that this is why I encourage, if you're going to use this strategy, do it on stocks that you're familiar with, because that's going to allow you to truly make the decision as to which one of these strategies do you use. You're going to be able to select or decide, is it time for me to get out of this particular trade or stay in? If you understand the stock, if you understand the company, you're going to be able to be better informed in making that decision. So hopefully that helps answer the question as to what do you do after the stock drops significantly.
Yeah, I've seen a lot in there about assignment, and I was going through and answering them while we were talking, so that's a good strategy there. But it seems like a lot of people want to avoid assignment in some scenarios, which it's common for the covered call. Maybe it creates a taxable event if you have a lot of appreciation on that, and that's something to take account of. Whole different conversation, but it's just important to know the circumstances around it. So what you see in the passenger side. So number one on the short call or any short option, the only way to take away your assignment risk is by closing it out. So if you feel like it's going to happen, you have to remove that option. That is number one. Number two is you can understand when assignment is likely. So one, if extrinsic value is completely depleted, then your likelihood of assignment is extremely high because it's only value. So just always look at it through the eyes of the long option holder from the put or the call side. And if you were going to exercise and make money and not give up extrinsic value, you're most likely going to get assigned. That's the easiest way. And then the biggest thing to know, and some of the kind of one-off or more common, the most common is dividends. If you are a short call holder and there is a stock that's going ex-dividend, the person who wants to qualify for that dividend, they have to own the stock the day before that ex-dividend. So if the dividend amount is 50 cents and then the option is pricing less than intrinsic value plus 50 cents, it makes more sense for the long call holder to exercise. So your likelihood of early assignment is extremely high if there's a dividend. So those are things to watch out for, but it's super easy to do if you just see the actual value of the option, and then you'll see if your likelihood of assignment is high. That's it.
Thank you. I saw a couple of questions regarding, what do you do as you get closer to expiration on the cash secured put? From my perspective, the cash secured put is really one of the strategies that require the least amount of management around expiration. Either you still want to own that stock and you let it try to expire, either get assigned or expire worthless. Those are your really two choices. You really don't have to do anything. You let the market effectively help you determine whether you're assigned or that put option that you've sold expires worthless. My preference is to, if it's in the money as you get closer to expiration, is to let it get assigned to me, because that's the reason that I sold the cash secured put. I want to own the stock, so I want to take that opportunity to capture that to capture the stock itself, or purchase the stock itself. You can roll it out, but what you're doing is you're just simply this becomes a yield play rather than a capital appreciation play. So it really has to be a decision as to what's more important to you: income, steady monthly income from selling that cash secured put, or the capital appreciation of owning that stock. And that's how you determine whether you let it be assigned to you or you potentially roll that and collect more premium.
Yeah, I like Andrew's question. Why don't you want to sell puts below support area so you can consistently earn income without having to own the stock? So that really echoes on what Tony was saying. This, as we were going through the risk profiles, is essentially it's a bullish strategy. You want to buy the stock, you want to participate in capital appreciation. So if something, at least from my perspective, is below support, I'm probably not going to be bullish on it. So therefore, it's not something I would implement in wanting to buy the security. So just like Tony was saying, that's going to turn into an income strategy, not necessarily I'm utilizing short puts to buy the security. So you can certainly do that, but I would not be bullish in that scenario.
Yeah, and Kevin's asking a great question. Why not sell a shorter dated option? Because you're going to take in premium more often like weekly options. That's a really good question, Kevin. And the reason that you don't want to use weekly options here is because every single week or every single time frame that you sell an option, you're going to have a chance of being assigned on that. And what you're doing here is that, in theory, academically speaking, if you were to sell, let's say, 10 call options in a row, you're going to collect more income selling 10 weekly options than selling one single option that expires 10 weeks from today. But in the 10-week option, you only have one point in time where you could potentially, generally speaking, be assigned. But if you sell 10 weekly options, you're going to have 10 opportunities to be assigned. And chances are you're going to get assigned sometime before you get to that 10th weekly expiration. So that's why, and because of that, you're generally going to actually collect less premium in the long run, because you're going to likely get taken out in that maybe second, third, or fourth week, and you're going to never collect as much income as if you sold that 10-week option. Now, so the math, while in an academic and theoretical perspective, you are correct, but when it comes to practical terms, on the weekly option, if you sold a weekly cash secured put, you might collect a very small fraction of the premium, and that small fraction is all you're ever going to get on the discount. So you're not truly getting a big discount on that stock purchase. And number two, when you're doing weekly options, you significantly increase the transaction cost in terms of the bid-ask spread that you're paying to get in and out of that particular trade. So for those reasons, practically speaking, selling weekly options will almost never quite yield you the theoretical edge that you get from selling weekly options rather than monthly options. Ken is asking, did your backtest that indicated a 15 optimal delta for the cover call reflect the possibility of rolling the call up and out when the premium or when the call becomes in the money? Ken, yes, we did look at rolling these types of strategies out, but that's exactly what I meant is when you consider the roll itself, right? If the stock rallies above, goes in the money and you have to pay a debit to roll that up, that debit is going to offset the gains that you have in the underlying stock itself. So that's exactly what we accounted for. And that's exactly what we were trying to achieve, is that when you sell cover calls, when you roll them up, you're not paying a debit in order to do so. A debit, in the long run, not necessarily for each individual call that you've rolled. Great question here. Would you be influenced by the expected direction of the market, likely down in the next 45 days, for example, to go for a higher delta on a stock? That's a really great question. And the answer is, personally speaking, the answer is absolutely yes. Statistically speaking, you shouldn't be influenced by your directional views on the market because, one, our directional views are not always correct, but ultimately that is your personal decision. If you feel very strongly about the market is going to roll over, then tactically speaking, it would be better to sell a strike price very close to the current price when it comes to that cover call. So tactically speaking, I agree with you. Statistically speaking, from a probability-based approach speaking, the data clearly shows that 15 delta is where you want to be consistently.
Remember, it's bullish. We want upward momentum.
What are the criteria used to scan for stocks in the cover call and cash secured put reports? Great question. It predominantly is around, how large the stock is and liquidity. It's really stocks that we feel you can sell cover calls and cash secured puts on. If you wanted to sell calls and cash secured puts on, you're going to be able to do so very close to the midpoint of the options price. This means that what we are calculating as the annualized yield on those returns are very accurate in terms of what you can actually be executed on those particular trades. So S&P 500 stocks, very liquid stocks, and ETFs are largely what make that particular list. So it's not based on fundamentals, it's not based on technicals, it's purely based on liquidity so that you have the full universe to your disposal, however you determine, it's time for me to potentially buy or sell a particular stock. It should be on that list as long as it's liquid.
Here's a good question from Ralph Tony. Should the IV be above or below 25% when you are selling puts? So I know we've had a lot of conversations about implied volatility. So at least from my perspective, I think a set number isn't the way to look at implied volatility. I look at it in comparison to everything else on the option chain. So some just are high as they are, or they're there for a reason, and it's most likely earnings or something like that, which is what I would want to avoid in a short put scenario, just because of the upward momentum that's possible. So it's really relative to where it is for the security and why there has high V. If there is a higher IV, there is a higher premium, and that is something you could capitalize on. So it just depends on if you agree to the reason why there's some sort of anticipated movement up or down, and that reason why is still you being bullish for the cash covered put situation. I don't know if you have any other thoughts on that one, Tony.
Yeah, so this is really where implied volatility rank is what you want to look at, not just a raw level on the IV, because Apple's going to have a low IV compared to, let's say, Moderna, right? And you don't want to use just one single level because it doesn't account for some stocks are being more volatile than others. But IV rank looks at how where is the current implied volatility of that stock relative to its own history. So for example, if let's say Moderna's implied volatility ranges between 50% and 150%, Ivy rank tells you whether right now we're closer to the 50% side of the range or the 150% side of the range. So when Ivy rank is at 100, that tells you you're at the 150% range. If it's at 0, then it's telling you it's closer to the 50% range. And generally speaking, what you want to do is you want to be selling implied volatility when it's towards the upper bound of its range. So anything above 50% on implied volatility rank is the best opportunities to sell premium on that. So don't look at IV, look at IV rank or IV percentile. Those are two indicators, depending on what platform you use, that give you access to that information. And OptionsPlay does that here for you as well. So when you log into OptionsPlay, for any symbol that you type in, there is a IV rank indicator that tells you on a score of 0 to 100, where is the stock's current implied volatility relative to its historical range. The closer it's to 100, the more it is towards the upper bound of the range. The closer it's to 0, the closer it is to the lower bound of that range. So that you can find on your platform, and it is also on both the cover call and short put reports, the implied volatility rank column here that tells you how, for example, where the stock currently is relative to its own history. Where do I find delta in OptionsPlay? So in OptionsPlay on the platform, when you use the strike drop-down menu, so if you click on modify for any strategy, and you click on the strike drop-down menu, there's going to be 3 numbers. You have your strike price, your premium, and your delta calculation. So that's how you can easily choose a strike price based on delta on any strike price drop-down within OptionsPlay. Kevin's asking a great question. If a cover call optimal delta is 15, what about a cash secured put? It's usually in the 30 to 40 delta. I lean closer to 40 deltas because, again, you want to have strike prices that are close to the current price that increase your probability of owning the stock. So Daniel's asking a great question. I spoke on CNBC last week about getting more tactical and aggressive on selling cover calls in the market because of the view that Carter had that the markets were turning over. He ended up being correct. So this is really an add-on to the previous question about, do you change your deltas? Do you change your strike prices if you feel strongly that the markets are about to roll over? And the answer is yes. So that's really where you can get to that 30 delta strike price. When you do feel, tactically speaking, markets are turning over, it's time to get a little bit more aggressive. Selling that 30 delta is what I would use when I'm in that tactical moment of things are starting to turn over. I still want to remain invested and I want to generate income. What strike price do I use? That 30 delta is where I would go for a cover call in that scenario.
See a lot of comments on collars. It's not necessarily a component of the wheel strategy, but it's certainly something you can do to protect yourself against downside risk. Just purchase a put in that situation.
And this is really where it's impossible for Jess and I to cover every single possible combination that you could possibly use options in. But this is really where we want to spend the time helping you build the foundations that you need to start building more creative strategies. A collar is a strategy that we will likely cover in our sessions, but what you're doing is you're selling a cover call and then you're buying a put in addition to that. You're taking the premium that you've collected on the call option to buy a put option, and the put option provides some further downside protection at a lower cost because you've sold some calls against it. But again, to better understand that, you really have to understand the fundamentals of calls and puts, something that Jess covered last week. And once you understand those fundamentals, they create the building blocks of every single advanced strategy. So make sure you understand those building blocks, because that's going to help you understand all of these different possible combinations that you can use options for.
One more from Jonathan that I think is pretty relevant. If the stock blows through your covered call by $6 to $8 and still has 40 days left, being happy with appreciation or wait for it to call away. So something that we will cover when we get to the first one on the intermediate series, or the seasoned investor, when we go through that course, but is the way that a option reacts when it becomes really deep in the money. So that's where it's going to be really important there. So if it's going really high through your strike, when an option gets really deep in the money, it starts having a delta closer to 1, which means it depletes all of its extrinsic value, which is going to be good for you. It's just something you want to really carefully watch, and you may want to consider rolling it if it's got that much time left before that is completely depleted, or when it's completely depleted.
Yeah, so this is something that I think is a really good question, and this is something that we will cover more in future webinars as we start to get into some of the Greeks and talk about kind of the Greeks and how they factor into your decision-making process as to whether you might want to hold on to a trade or get out of it. With that, I think that covers enough questions and time that we have for. Again, I want to thank Jessica for putting together this fantastic session here on the wheel strategy and diving really into the two components with those fantastic graphics that she's put together to hopefully illustrate and make this a little easier for you to understand. And I want to thank all of you that are viewing here today for taking the time out this afternoon and coming back every single Thursday for these education sessions. We are sending out a survey recently to ask you for your feedback on these sessions. What do you like? What do you not like about them? Let us know. What do you want to learn more about? That's going to help Jessica and I craft the direction of these education series. But we are here every single Thursday to do these sessions, to show you option concepts, how you can implement them using OptionsPlay. So thank you so much for your support, and we appreciate that. And looking forward to coming back here next Thursday and doing our next session. Really looking forward to that. Jessica, thank you so much, and have a great evening.
Yeah, thanks, Tony. Thanks, everyone.